Founders call it growth capital, but for many, it becomes change capital. The day you take that money, you sign an invisible contract, a bargain that fundamentally alters the DNA of your business forever. So let's try and understand today a completely new subject, which is about what is the true cost of capital for an entrepreneur. You'll probably give the right answer. Those answers could be it's our interest rate, it's the equity that we dilute to get money from lenders, it's the WACC, weighted average capital cost. But truly understanding this is not the true cost of capital. This is just the price tag. So my job today is to help you see beyond that price and calculate what's the true cost in our lives as entrepreneurs when we borrow capital. The debt that doesn't show up on a spreadsheet, the invisible toll on our freedom, on our culture, and on our original vision. This isn't about funding. It's about creating a framework, a founder's due diligence checklist to stress test any offer before you sign on the dotted line. So let's start by quantifying the freedom tax, as I call it, the cost of relinquishing control. This isn't just about losing a board seat. It's about losing the right to make the best decision for the long-term health of your company. The key metric here to be evaluated is strategic loss value. Every funding round has constraints on your system. New KPIs are introduced, faster timelines are asked for, or veto rights are also need to be given. To calculate your SLV, you must identify your most valuable alternative decision and assign it a dollar or a rupee value. So let's take an example to understand this concept better. If taking money requires you to launch a product in 6 months instead of the ideal 12, how much is that lost quality and technical depth going to cost you in rework, churn, or brand reputation 2 years from now? Let's say you estimate a rupees 5 lakh future debt. That's part of your strategic loss value. Let's take another example to understand another constraint which is put on the system. I call this the exit constraint. Your ideal exit is 5 years from now to build a sustainable platform. The investor demands a return in 3. The cost is the net present value or the NPV of the 2 lost years of high margin, profitable growth you will forfeit in order to achieve this objective. You must add the potential SLV to the visible price. If the cash received minus the SLV is still a substantial net positive, the check that you receive might be worth it. If the SLV approaches or exceeds the cash value, you are buying a prison cell with just a better view. Now, let's look at other pitfalls which are not so visible, but they include erosion of culture, discipline, and efficiency within your organization. So let's understand what is meant by culture erosion here and how does this manifest within our companies. This manifests as the burn rate mentality, as I call it, and inefficient growth. We actually need to create a framework to understand this decay, which we can call as the culture multiplier. When you inject large amounts of capital, the pressure to hire and spend often lowers your revenue per employee. The cultural multiplier is designed to quantify this drop in efficiency. So how is this calculated? A simple mathematical formula could be that the cultural multiplier is nothing but the projected revenue per employee without funding divided by the projected revenue per employee with funding, which is basically due to fast hiring. And this percentage or this factor minus 1. If your revenue per employee, let's say, drops from 200,000 or 2 lakhs per employee to 1.5 lakhs per employee due to rapid hiring, your cultural multiplier is 0.33. Now, how do we take action, in order to protect our organization. So the actionable step is you multiply this 33% by a total projected payroll increase over the next 3 years. That number is the monetary cost of hiring not so great people, the financial waste created by sacrificing cultural fit for speed within the organization. Positive cultural multiplier is a massive red flag. It tells you the capital is making your company fatter, not fitter. The culture debt is paid by your employees in the form of confusion and cynicism about the steps that the top management is taking. Another aspect that really needs to be considered when looking at the cost of that check is what is the dilution of our mission or the true cost of vision dilution that happens because of the funding that we are receiving. So the pitfalls to be focused on are, essentially that what is the long-term product vision dilution in order to achieve the short-term metrics. So this is the ultimate sacrifice, the true measure of the cost of capital. This is where metrics over mission destroys long-term value. We can quantify this using a concept called terminal value impact. So your initial vision, if executed perfectly, would lead to a certain terminal valuation. Let's call it V original. The funding forces you pivot towards, they force you to go towards short-term metrics and resulting in a new compromised terminal valuation. I call it V compromised. So the terminal value impact is the difference between both of these values, V original minus V compromised. So think of the founder who had to scrap their ambitious global education platform to focus solely on a profitable but limited corporate training module. They traded the chance at a 5 billion company for a safe 500 million exit. So the check you are taking must compensate you personally through the equity price for the terminal value impact you are sacrificing for the investor's safer, faster exit. If the current valuation is low, you are taking a tiny slice of a smaller potential pie. So your conviction in your original idea must be strong enough to reject any capital that forces a valuation which is highly compromised. You must check, all these parameters, they must be checked through the lens of your terminal personal net worth, not just the cash which you see in the bank today. So let's bring it all together. The question is not simply, should I take this money? The question is, does the visible price justify the true cost that you are paying for it? And to round it up, I would just like to give you a founder's due diligence checklist for calculating the worth of the check that you are receiving. So always look at three points when doing this evaluation. The first is calculating the strategic loss value, quantify the dollar cost of the lost operational and timeline flexibility. Second, the cultural multiplier estimation, estimate the financial waste due to enforced inefficient hiring and spending. And third, calculate the terminal value impact. Understand the difference between your original vision's potential worth and the investor mandated vision's worth. Only when the check's value comfortably exceeds the sum of the strategic loss value and the financial cost implied by the loss in cultural vision and the terminal value impact, are you truly making a smart move? So taking capital is like igniting a rocket. It provides incredible thrust, but it locks in your trajectory. Use these calculations wisely to ensure that the trajectory leads exactly where you are as a founder and where you want to go. Don't just go blindly for any checks that are dangled at you.